Okay, welcome to the October 4th edition of the Fats, Fuels, and Oils webinar. You can tell by my background and the fact that I'm wearing a hat and not a shirt today that I'm not in my normal spot. Thankfully, made it through the hurricane relatively unscathed. And have been a lot more fortunate than a lot of people, and also fortunate that my friend has graciously allowed me to stay at her house, and she has power and internet. I'm still waiting for my power to come back on, but hopefully that will all be fixed up and you will be back to, or I'll be back to normal next week. Okay, so let's talk about what has been happening. There we got, let's see, we got the quarterly grain stocks report. We also got monthly EIA data and the monthly fats and oils data. I think that maybe the biggest surprise for the market was the quarterly grain stocks report, in part because USDA raised their old soybean crop, so not the crop that's being harvested right now, but the prior crop, by 30 million bushels, and that because we've got all the crush data and all the trade flow data, that just falls right to the carry out. And so that seemed to surprise the market a little bit. And so soybeans fell and then soybean oil fell. Since then, we've had stories about OPEC potentially cutting 2 million barrels of production a day, and that has fired up energy prices, and soybean oil is responding as well. Soybeans have started to recover from the decline following the grain stocks report. I think in part on a little bit on the strength in soybean oil, but also the 30 million bushels was not enough to really make a significant difference. Like, I think it was a surprise to the market, but it wasn't. It's not like it's so much extra carry out that this year then all of a sudden is magically going to, we're going to have ample soybean stocks. And so I would expect that soybean prices will tend to drift a little bit higher, at least until we get well into South American planting. I know that at least as of a week and a half ago or 10 days ago, things were going well in Brazil. It's still a little early for Argentine planting, but it had been or continued to be dry in Argentina. And I think that remains a concern because La Nina is still kind of sticking around. And that was as expected. It was kind of expected to sort of start to fade in the winter, but definitely sort of be around through the fall. And so as a result, Argentine planting may be a bit delayed, although there's still time for rain to fall in Argentina and improve soil moisture conditions. But at least at this moment, I still expect that South American weather will return to normal. And so I think that soybean complex prices probably can drift a little bit higher until the market gets a little bit more assurance about what the South American crop is going to look like. And then once that happens, as long as La Nina is actually fading and is at least predicted to be gone or is gone by the time that we get into the real South American growing season, then I think that expectations for record Brazilian production and if not record, at least good Argentinian production will probably weigh on soybean complex prices a bit. Now, offsetting that, at least for soybean oil, has been some strength in the demand for soybean oil as a biofuel feedstock. And that is due in part to the strength in the profitability of soybean oil. And so the first thing that I want to share is this. And I'm gonna flip around a little bit in this one, so bear with me. Okay, so this shows basically our estimate of the profitability of soybean oil as a feedstock for renewable diesel and biodiesel that ends up in the California market. And as you can see, the decline that we've had from the peak in soybean oil prices against a relatively slower decline, particularly for biodiesel in energy values, has meant that soybean oil profitability for both renewable diesel and biodiesel have been as strong as they've been in a long time, more than a year, obviously. And that probably will continue. I think it's kind of on the energy side, whether this continues or not. I think soybean prices are closer to an equilibrium now than they have been for quite a while, despite the volatility that we're seeing today. And so I think that whether this continues, this level of profitability continues, will depend a lot on whether energy prices go up or concerns about or an actual world slowdown in economic activity brings energy prices down and then limits the profitability of biofuel production generally and biofuel production using soybean oil more specifically. If you look at canola, you can see canola is really doing well in terms of profitability as a feedstock. And while the EIA data is a couple months old, so we got data for July last week, I think that the EIA data reflected strong demand for biofuel for both soybeans and soybean oil and canola oil. The soybean oil total of it was about 950 million pounds, was about 50 million pounds above our expectation. And given again that was July, and as you can see, things have improved for soybean oil generally since July, and certainly for canola. Canola oil was back to sort of the 130 million pounds that we used to kind of, if not routinely, see certainly much more frequently than we've seen over the past year or so. And this is really why. And so I would expect that in over at least the next couple of months, that will continue, or in the next couple of months data that will continue. And again, I think that that both prices have kind of settled into a bit of a range. Doesn't mean again that we're not expecting, if South American production goes well, that we're not expecting prices for feedstocks, vegetable oil feedstocks, to come down a little bit, which could potentially improve profitability. But I think probably the bigger question, at least in my mind at this point, is on the energy side, and whether energy prices are going to go up on this potential cut in production from from OPEC, or will decline because the world economy is going to slow down. A lot of whether the world economy slows down or not will depend on whether central banks continue to tighten or start to ease up on tightening a little bit. I think the equity market, at least right now, thinks that the central bank tightening, if it's not going to stop, at least it's going to slow. And there was some indication of that the Australian central bank today raised rates a little bit less than expected. And in the past week or 10 days or so, in Britain, you had the new sorry, I can't remember what they call the head of their government at the moment. Anyway, she came out with a proposal to cut taxes that sort of forced the central bank to reverse its position on, or reverse the quantitative tightening that it was doing, and start to buy bonds again, which they're doing at the same time that they're kind of easing interest rates. But it's also an indication that maybe they are a little bit closer to stopping increases in rates than the markets thought that they were, at least 4 weeks ago or 5 weeks ago, or even less than that. Now, I'm certainly no expert on interest rates or Fed policy, so I'm not going to pretend to try and say whether I think that that's what's going to happen or is not what's going to happen. But I think that that's what the market is thinking is going to happen. Yesterday and today, you've seen equity markets just really move sharply higher, and also you've seen a big bounce back in energy prices, crude oil prices specifically. Okay, so one other quick thing that I'll show you here, and then we'll get out of this. And this is, sorry, just skip through this stuff. I apologize. Where is this chart that I'm looking for? Let's see, I'm still a little discombobulated. Come on, where is that chart? Okay, here it is. So this compares, basically, this is, instead of just focused on soybean oil or canola oil, this compares the profitability of all of the oils. And you can see that soybean oil now is basically the third most profitable feedstock choice, behind just yellow grease and UCO, at least by our estimation, just above choice weight grease, and certainly well above some of the other relatively popular fats and greases like bleachable fancy tallow, and to a lesser degree poultry fat, but distillers corn oil is also down there near the bottom and close to sort of breaking even. And so I think that, again, I think what this means that we'll see in the data as it's released in the coming months is probably a shift more towards using vegetable oils as feedstocks, and away a little bit from fats and greases. Now, the only counter, maybe not the only, but a counter argument to that idea is that, given the difference in the CI scores for fats and greases relative to vegetable oils, and what we've seen happening in LCFS credits, the fat and grease demand could continue to be supported by sort of trying to get every penny out of the LCFS credit that you can based on the CI scores. Still, I think that that given that that the LCFS market is obviously a really important market, but it's not the whole market, right? And so if you're not shipping to California, then soybean oil is at least in my mind the clear choice for renewable fuel or renewable diesel or biodiesel feedstocks, unless you can get fats and greases for less than we're reporting, or less than we're estimating. Again, I just say all of that to say that I think that you probably will see, and we probably will raise our forecast for vegetable oil consumption in biofuel production, probably modestly over the next couple of months, the last 2 months that we don't have data for 21, 22, and then probably a little bit more for 22, 20, 23. I don't think that we will really be super aggressive about 22, 23 yet, because I think that if this demand develops, while I think last week or the week before we talked about how we think they probably will be ample feedstocks, and we may continue to have sort of ending stocks around kind of the 2 billion pound level. Well, if all of a sudden we start to use a lot more vegetable oil for biofuel production, then the expectations for 22, 23 ending stocks will start to come down. That will probably support soybean oil and vegetable oil prices, make them a little bit less profitable. The other thing that you could see happen is that, there's always kind of a lag in the move for fat and grease prices. And while we haven't really seen the same level of decline in fat and grease prices that we have in vegetable oils, if we start to shift some of the demand away from biofuel feedstock demand for the fats and greases towards vegetable oils, then maybe you start to see some weakness in fat and grease prices, and then that makes them more attractive and makes them more profitable. So because of all of that, it's not like I'm just going to shift my 22, 23 forecast to feature another 1 billion pounds of soybean oil demand for biofuel feedstocks, or cut 1 billion pounds of feedstock demand out of the fats and greases. All right, with that, go back to our regular, and I'm writing stories this week. I promise I actually will publish a report, and again, apologize that I didn't publish one last week. Because of the path that the storm took, we were kind of okay until about the last 24 hours, and then all of a sudden we weren't okay, and so I needed to do a lot of things to get ready for that, since I live not on the water on the Gulf, but on canals that are connected to the Gulf. Anyway, we'll have stories this week, and I will finish them this afternoon and this evening, and so you can see those tomorrow for sure. As a result, I refreshed all of this stuff, and I thought that it would update, but it may not update. But we will go through, and I'll talk about the regular stuff that we talk about anyway. These don't look like they've necessarily updated. Okay, so what happened in our estimates for biofuel profitability and credit prices over the past week or so? For biofuel profitability, renewable diesel profitability kind of continued to move a little bit lower. It has it's kind of following the path that we expect, which is getting down closer to the $2 per gallon level. That's due in part to part of it is, again, because we use fats and greases for our renewable diesel feedstocks, and we use soybean oil as a primary feedstock for biodiesel. That has a little bit to do with it. So you haven't seen really a huge decline on the cost side for renewable diesel, and so that shades our estimate of renewable diesel profitability a little bit, but we expect it to kind of move lower, our estimate to move lower through the rest of the year, and kind of get down towards that $2 a gallon level. Last week we estimated that and apologize for looking off screen here, renewable diesel at $2.10 a gallon. For biodiesel, we estimated at $2.18 a gallon last week for renewable diesel. For biodiesel, 71 cents. Renewable diesel was up from $2.10 the prior week, so up 8 cents during the week. Renewable diesel or biodiesel was down from $1.18 the prior week to 71 cents, and that was a bit of that was some strength in soybean oil prices before we got the quarterly stocks number on Friday. In terms of the prices for the fuels, again, you're seeing a little bit weaker renewable diesel prices. The price of biodiesel without the credits has remained strong and actually kind of moved higher. So it moved from $3.62 a gallon last week to $3.70 a gallon this week, and that's up from $3.56 a couple of weeks ago. You compare that with renewable diesel. Renewable diesel rose to, fell 2 cents to $3.33, down from $3.35 and from $3.39 the prior week. So you can see renewable diesel is getting just a little bit weaker. Biodiesel has held and actually moved a bit higher. Again, I think that this has a lot to do with the need to sort of make up for the gap in ethanol production and the undifferentiated advanced mandate that has kept biodiesel capacity still pretty close to where it has been. The latest data from the EIA showed that there was a slight decrease in biodiesel capacity in July. It wasn't really significant. I think it was, I'm not even sure if it was 100 million gallons. And conversely, we had an increase in renewable diesel capacity of about 150 million gallons. Maybe it was a little bit less than that. But that build out kind of continues. The increase in renewable diesel capacity, basically in line with what we had expected. It was a little bit stronger than we had expected, but in line with our expectations. For biodiesel, in general, we don't have sort of really detailed forecasts of when we think the biodiesel capacity is going to come off, beyond sort of the idea that biodiesel capacity probably doesn't get rationalized that much this year, and holds on in 2023, at least until the renewable diesel capacity build out is sufficient that it really starts to take biodiesel margins down. Then I think you could see some rationalization. But it's unclear to me that has to happen in 2023. Now in 2024, then I think you start to see sort of that aggressive rationalization in biodiesel capacity. So as a result of that, we think that that biodiesel margins remain elevated relative to sort of history, and we think that we don't necessarily think that they hold sort of that $1 a gallon level that we've seen a couple of times over the past month or so, but probably trend down into this somewhere between 85 cents and 70 cents, or maybe even a little bit lower than that, but probably not significantly lower than that through the end of 2022. Okay, so let's look and see if our RIN forecast updated. Nope. All right. So I guess this will update once I publish the reports. And again, apologies that you haven't had new charts and new data in a couple of weeks. And I'll get this stuff done as quickly as I can. I thought if I just refresh the data that it would refresh the charts, but it must be waiting on me to publish a report. I can tell you what we did in our RIN price forecast. So what we saw over the last week was a little bit of weakness in D6 RIN prices. And so the spread between D6 and D4 widened out just a little bit. a little bit surprising given the anticipated shortfall in ethanol production. I think that we didn't really see a similar, obviously, since the spread widened, we didn't really see a similar decline in D6 prices or D4 prices, and D4 prices have kind of been holding steady. So what I did this week is in the short term, I basically widened the spread between D4 and D6 a little bit. So basically what that meant was I took D6 down just a little bit, and kept D4 pretty much the same. I moved it down just a touch from sort of where the model wanted to put it. But then we still have the spread narrowing into the end of the year. However, if this trend continues where the spread is going to widen or at least hold the current levels, which are about $15, then I think that it probably will change my D4 forecast into the end of the year. We kind of have D4 going up into the end of the year. And if D6 isn't going to be there to support it, and we don't get a big rally in feedstock prices, then I don't see any reason that the D4 spread will need to really be test the old highs or rise above the old highs or get to 200, which is something that it looked like it might be able to do heading into the end of the year. I think that if that spread kind of even holds it at its current level, that probably takes that level of increase in D4 prices off the table. Now, that said, again, if you think of the RIN price or the function of the RIN, is to encourage production to a certain level. What has been going on in LCFS prices, and the impact that they're having on the overall profitability of both renewable diesel and biodiesel producers would suggest some support for RIN prices. Now, feedstocks are obviously the most important component of RIN prices, but again, if you think of sort of the function of a RIN is to guarantee enough margin to get production at a level that meets the mandates, and some portion of production is going into the LCFS market, and the LCFS market has continued to move lower, then in theory, that means that that margins on a portion of the domestic production are going to fall, and further in theory, then production that was going to the LCFS market might get shut down. And in that case, then maybe you need RIN prices a little bit higher to encourage the producers to continue to produce even as LCFS prices continue to fall. So this week, and again, I don't think it shows up in the chart, but this week we cut our LCFS forecast. Now it looks to me like we probably could test that sort of theoretical bound at lower bound at $50 a metric ton. And it may be that level doesn't hold. I think that is the lower bound of where the LCFS credit can go. But it has sort of very steadily continued to move lower, and nothing has seemed to stop it. And so while I think that you start to, I think that at $50, you start to make it difficult to justify the logistical cost to get the fuel into the California market. It doesn't, I guess, necessarily mean that that's absolutely going to happen, but it looks like we're probably going to find out here before the end of 2022 and maybe even much sooner than that, maybe within the next month or so, given kind of what we've seen in LCFS credit prices. Our thinking in the longer term is still broadly the same, that LCFS credit prices probably will remain weak through 2023. And then as CARB starts to implement some of the changes that they have proposed and have discussed, at least publicly, then I think that you probably will start to find some strength in LCFS credit prices in 2024. Now, the exact level of that strength and whether LCFS credit prices can get back to kind of the $200 level will depend a lot on the exact changes that are implemented. I think that if what they do is ban sort of or put a cap on the amount of biofuel that comes from veg oil, I think that that probably has a smaller impact than if they adjust the carbon intensity, essentially the ease of generating deficits and the difficulty of generating credits, or put more clearly, make it harder to generate a credit, make it easier to generate a deficit. I think if they adjust that, and that's you've probably seen that graph with sort of the line sloping down and to the right, and then they have their performance against that line. If they shift that whole thing lower, then I think that you probably would see a lot more strength in LCFS credit prices than if they just do a limit on veg oil derived biofuels. And if they do both, then obviously that would probably garner the strongest response from the market. Okay, that is about it this week. Again, thank you for your patience and understanding. And I am pretty sure I will be back to normal and on a normal schedule next week. And with that, somebody has been kind enough to ask a question. All right, do you see any sizable change in the demand for feedstock, as supposedly several large plants are scheduled to come online in coming months? Is the demand priced in? So I think that the market generally kind of knows the schedule of when these plants are going to come online. And further, the plants start to buy their feedstocks before they actually come online. Given what we're seeing in supply and demand, and in particular in the supply and demand of soybean oil, I don't know that feedstock stocks, if you take just feedstocks as a whole group, are going to be so tight that that we need a huge shift up in prices to kind of ration that demand out a little bit, or to try to convince the new plants to delay their opening. That said, obviously, new big plants coming online will provide a significant source of demand, and probably will have a more significant impact in the local markets than they will in the overall market. And unless they come online and all of a sudden you start to see it, and it's really soybean oil stocks. We can talk about tallow stocks or choice weight grease stocks or even UCO stocks, but they're all generally relatively small, like really small. The biggest of the fats and greases stocks, at least are based on our estimates, is sort of 100 million pounds a month, and you compare that to 2 billion pounds for soybean oil, or even 150 million pounds for canola isn't really the isn't really sort of the marginal stock either. So it really comes down to, can you get enough demand to really have a significant impact on those soybean oil stocks and draw those down? And if you can't get those down below 2 billion pounds at the very least, I think you're going to have a hard time getting the market to really spike on whatever demand is going to come online. And based on our estimates and forecast, we don't really expect that to happen, at least through the first quarter of 2023. Part of that is because just seasonally you get more soybeans crushed in the fall after harvest than you do in the spring. And so there's just more soybean oil available. And so the timing of these new plants will coincide with the largest soybean oil supplies of the year. Now, as they continue to operate and as we get into the spring and the summer, then that demand might start to have a more significant impact on prices outside of the region where those new plants are going to operate. But it will certainly take, I think, a drawdown in soybean oil stocks, probably significantly below 2 billion pounds at this point, to really convince the market that this is going to be the year that we're really going to tighten soybean oil stocks significantly. I'm not saying that it can't happen, or that the market wouldn't react if we get down to 1.9 billion pounds. But I think, just given the history over the last couple of years, where at least the vast majority of analysts, including the USDA, all thought that stocks would draw down pretty significantly in 1920, and then again, or I guess in 2021, and then again in 21-22, and now in 22-23, there is probably a better chance than we had in those other years of soybean oil stocks drawing down. But I think the market, and certainly analysts, are probably going to be in much more of a let's wait and see if this actually happens before we really start to cut our estimates, and the market really starts to react to that. Now, again, that's the futures market that is divorced, obviously, from the local cash markets. And so to get a response in the futures market, that's what I think it would take. To get a response in the local cash market, those big plants just need to start buying. And as they start to soak up more of the supply from the regional feedstock producers, you probably will get a basis response there, and maybe even a strong basis response there. But I'm not sure that it will be strong enough to really propel the futures market significantly higher. At least that's not what we're projecting right now. It could be, especially if my forecast for stocks is a little too optimistic on how long it will be before we start to eat into the fairly ample stocks that we have right now. Right now, I expect stocks to continue to build through the first quarter, and potentially reach sort of the largest levels that we've seen since USDA has been publishing the fats and oils report, which is about 7 years, I think, at this point. I think they started in 2015. And so if that's our starting point, if 2.7 billion pounds of stocks in sort of the end of 2022, early 2023 is our starting point, it's going to take a long ways to get those down to a level that I think the futures market will really need to respond to and drive prices up to sort of record levels. Okay, unless there are any other questions, we will finish. Thank you so much for attending. I look forward to seeing all of you again next week, and hopefully back at my house. And until then, have a great week, and I'll see you all next Tuesday.